Coming to the next topic, that is investment decisions. We are covering the second part of the financial decision. The first part was the financing decision. Now the second part is the investment decision. Once the funds are been procured, are been raised, now the next step is to invest those procured fund somewhere from where we can fetch higher rate of return, or we can fetch profit out of it, right? So investment decision is about the investment of the funds or the procured acquired funds, right? Where to invest those procured funds. Those procured funds can either be invested in the long-term assets or the short-term assets, right? When these funds, they are invested in long-term assets, we call it as capital budgeting, because we are purchasing fixed assets, right? Whereas if such funds, such money is invested in short-term funds, that is called the working capital, right? Such short-term assets are the assets which can be easily convertible into cash, right, within a year, fine? So they are called short-term assets, right? Every firm, every company is having very limited resources, or you can say the scarce resources, whether it's labor, whether it's land, whether it's finance, fine. So they have very limited resources. Now comes the management role. Management actually makes a company to take wise decisions in order to make an optimum utilization of such scarce resources. So the company has to make decision how to make investment decisions in terms of using those funds, acquired fund, procured fund, in order to utilize them in an optimum way, where there should be more profit and less wastage, fine? Investment decision also decides upon the composition of the firm. Means composition of the firm is what will be the composition of the ratio of the fixed asset and the current assets, fine? Let's come to the long-term decisions, right? Long-term decisions means the decisions related to the purchasing of fixed assets, or that is called the capital budgeting. Means how much amount we are going to invest in purchasing or buying fixed assets, right? Fixed assets like for example a building, furniture, right, or any machinery, they are the fixed asset. Now how these long-term decisions, they are going to affect the company, right? Because you will see that when a company is purchasing or buying these long-term assets or the fixed assets, they should have a strong financial position, because these purchasing of long-term assets or the fixed assets, they involve a huge cost. That's why a company has to look at the capacity, their financial position, as well as the earning capacity of these fixed assets. For example, if we are going to buy a building, right, and that building will be given on rent, fine. So what rent actually we are fetching from that particular building, or if any kind of production is taking place on that particular building, so what profit, right, out of that production process we are going to make by using that particular building. So we have to see the rate of return, we have to look at the profit we are making after investing amount in that particular asset, right? So we have to look at the earning capacity of the long-term asset or the fixed asset wherein we are going to invest huge amount, right? Second, as I told you that purchasing of fixed asset, they involve a huge outflow of money. So again, a company has to be financially strong, and if a company is not financially strong, then they have to take a risk of investing in such fixed assets, because they involve a huge cost, and that cost cannot be, it is irreversible. Actually it is irreversible. Once that amount is gone, once you have purchased a machinery, fine, so you will not be able to get that amount back because you have now converted that cash into a fixed asset. So it is that particular cost is irreversible. You cannot undo your decision once you have invested in the purchasing of fixed asset, right? Why a company has to invest in fixed assets? Why? What is the need of capital budgeting, right? Need of capital budgeting, obviously, if I am buying a new building, if I am buying more furniture, if I am buying more land, right? Why? It only happens when a company is growing. Capital budgeting is required for the expansion purpose, for the diversification purpose, for the growth purpose, right? So if we are buying more and more fixed assets, it shows that a company is actually growing, it is expanding, fine. So for the expansion purpose we require capital budgeting. Now the factors affecting capital budgeting. What are the factors which generally affect the capital budgeting? First, the cash flow of the project. When we are deciding upon the investment in fixed asset, we look at the cash flow of that particular project. For example, I told you that if I am going to purchase a particular machinery, right, or I am going to invest in a particular project, fine. So what return, what profit am I making, right, out of alternative projects, right? For example, I have with me I have 2-3 options of investing in different project A, project B, project C. So before deciding upon the best project, I will look at the cash inflow, that how much profit I am making out of that investment. Project A is reasonable and regular cash flow. Am I getting a reasonable and a regular cash flow from project A, or from project B, or from project C? So I will look at the profit, a regular income, regular money I am making from project A, project B, or project C. Then I will decide that in which project I am having high amount of cash flow, and I will choose that particular project, right? Second, rate of return. Now again I will compare different projects, project A, project B, and I look at the rate of return. For example, from project A there are chances that I am going to get only 10% rate of return, right? But while on project B I am going to get 12% or 15%. So obviously I am going to invest in project B, right? Now comes to the third point, that is the investment criteria. How do we make the investment decisions, fine? For example, if I am deciding project A, project B, project C, as I told you, return is 12%, 15%, 20%. So how do we decide that return, right? How do we anticipate that return, fine? So for that we use some capital budgeting techniques, right? For example, net present value method, or you can say payback period method, or the return on investment method. Payback period method means if I am investing 1 crore rupees in for buying certain particular machine, for example I am investing 1 crore rupees, then I look at the payback period, that how long will it take to make this 1 crore rupees at par, that how long will that machinery take to give me a profit of 1 crore rupees. So that will be the payback period method. I'll be able to make my investment equivalent to my profit, fine. And the return on investment method. Now let's come to the next thing, that is called the short term investment decision, means a B part of the investment decisions, fine. That is, if I am investing in short term assets. Short term assets are called the current assets, right? And current assets, as I told you, such assets, they are called the working capital also, and such assets can be easily convertible into cash within a period of a year, that they are easily convertible into cash. For example, your debtors, right, they are example of working capital. Stock, they are the example of current assets. So where you are going to invest either in the fixed assets or in the current assets, that is a part of investment decisions.